In the scorching summer of 1929, while America danced to the intoxicating rhythm of endless prosperity, one man sat quietly in his Manhattan office watching the numbers dance across the ticker tape with the cold precision of a surgeon studying an X-ray. Jesse Livermore had already built and lost several fortunes by this point in his career, and what he was seeing on that tape filled him with a mixture of anticipation and dread that few men on Wall Street could possibly understand. The market was reaching heights that defied all logic, all precedent, all sense. Stocks were trading at valuations that made even the most optimistic bulls pause for breath. Yet the buying continued, fueled by dreams of easy money and the dangerous belief that prices could only go in one direction. Livermore knew better. He had seen this movie before, and he knew exactly how it would end. What separated Livermore from the thousands of speculators who would soon be wiped out in the coming crash wasn't his ability to predict the future. It wasn't some mystical gift for reading market tea leaves. It was something far more practical, far more disciplined, and infinitely more powerful. It was his unwavering commitment to a set of risk management principles that had been forged in the white-hot crucible of repeated financial ruin and resurrection. These weren't theoretical concepts dreamed up in some ivory tower. These were battle-tested rules written in blood and tears, carved from the wreckage of blown accounts and shattered dreams. They were the difference between being a player and being played, between surviving the market's inevitable storms and being swept away by them like debris in a hurricane. Today, we're going to dissect the 8 core risk management rules that allowed Livermore to not just survive, but thrive in markets that destroyed lesser men. These principles transformed him from a small-town farm boy with $5 in his pocket into one of the wealthiest men in America. More importantly, they kept him in the game long enough to capitalize on the opportunities that the market occasionally presents to those patient enough to wait and disciplined enough to act. But before we dive into these rules, you need to understand something fundamental about the nature of speculation itself. The amateur comes to Wall Street asking one question and one question only: how much money can I make? This single obsession becomes his downfall because it blinds him to the far more important question that should dominate every decision he makes. The professional speculator, the man who has learned to navigate these treacherous waters successfully, operates from an entirely different mindset. His first thought isn't about potential profits. His primary concern, his constant companion, his most sacred responsibility is understanding and managing risk. He asks not how much he can make, but how much he can afford to lose. This fundamental shift in perspective is what separates the wheat from the chaff in this business. Think about it this way. A general doesn't march into battle thinking only about the glory of victory. He studies the terrain, counts his ammunition, assesses his supply lines, and plans his retreat routes before he ever considers his attack. The speculator who ignores these basics is like a commander who sends his troops into battle with no plan, no strategy, and no understanding of what he's up against. Livermore understood this better than perhaps any speculator who ever lived. His rules weren't designed to maximize profits, though they often had that effect. They were designed to ensure survival, to guarantee that he would live to fight another day regardless of how any individual trade or market cycle played out. Let's start with the foundation of everything else, the bedrock principle upon which all successful speculation must be built. Rule number 1, preserve capital above all else. This isn't just a suggestion or a nice idea to keep in mind when things get tough. This is the prime directive, the North Star that guides every single decision a professional speculator makes. Your capital is your ammunition in the war against market uncertainty. A soldier without bullets can't fight no matter how brave he might be. A speculator without capital can't speculate, no matter how brilliant his analysis might be. The moment you start treating your trading capital as anything other than the most precious resource you possess is the moment you begin your journey toward financial oblivion. This means that every trade, every position, every decision must first pass through a simple filter. Does this action increase or decrease the risk to my capital base? If the answer is that it increases risk beyond acceptable levels, then the trade simply doesn't happen. No exceptions, no special circumstances, no gut feelings that override this fundamental law. The amateur sees this as being overly conservative, too cautious for the fast-moving world of speculation. He wants action, excitement, the thrill of big bets and bigger payoffs. But the professional knows that speculation isn't about thrills, it's about mathematics, probability, and the cold calculation of risk versus reward. The thrill seeker ends up broke. The mathematician ends up rich. This brings us directly to rule number 2. Cut losses quickly and without emotion. If preserving capital is the prime directive, then the swift elimination of losing positions is its most practical application. A small loss is nothing more than a business expense, the cost of testing a speculative hypothesis. A large loss is a cancer that will eventually destroy your entire operation if left untreated. The market has a way of delivering its verdict on your trades with brutal honesty. When you buy a stock at $50 and it immediately drops to $45, the market isn't being mean to you personally. It's simply telling you that your initial judgment was incorrect. The tape doesn't lie, doesn't play favorites, and doesn't care about your feelings or your financial situation. The professional speculator accepts this verdict immediately and acts accordingly. He doesn't argue with the tape, doesn't hope for a reversal, doesn't convince himself that this is just a temporary setback. He closes the position, takes his small loss, and moves on to the next opportunity with his capital and his peace of mind intact. The amateur, driven by ego and the painful sting of being wrong, does exactly the opposite. He holds the losing position, hoping against hope that it will come back. He tells himself stories about why the market is wrong and he is right. He watches his small loss grow into a large loss, then into a devastating loss that wipes out months or even years of previous gains. This leads us naturally to rule number 3. Never, under any circumstances, average down a losing position. This is perhaps the most counterintuitive rule for beginners to understand because it goes against what seems like common sense. If you liked a stock at $50, shouldn't you love it at $40? If it was a good buy at the higher price, isn't it an even better buy now that it's cheaper? This logic is fatally flawed because it ignores the one thing that matters most, the market's own judgment about the stock's current value and direction. When a stock drops from 50 to 40, it isn't becoming cheaper in any meaningful sense. It's becoming weaker. The decline itself is evidence that the forces of supply and demand are working against your position. To buy more of a declining stock is to compound your original error. You're not averaging down your cost basis. You're throwing good money after bad, increasing your exposure to a position that has already proven itself to be on the wrong side of the market's movement. You're trying to catch a falling knife, and in the process, you're likely to get cut even deeper. The mathematics of this mistake are particularly cruel. Let's say you buy 100 shares at $50, investing $5,000. The stock drops to 40, giving you a $1,000 loss. If you buy another 100 shares to average down, you now have $10,000 at risk instead of $5,000. If the stock continues to decline to $30, your loss has grown from what would have been $2,000 on the original position to $4,000 on the doubled position. Rule number 4 provides the positive counterpoint to the defensive nature of cutting losses. Let your profits run. While the amateur is quick to hold his losers and slow to cut them, he makes the opposite mistake with his winners. The moment a trade shows him a profit, he's seized by the fear of giving it back. He sells too early, taking small, nervous gains that are mathematically guaranteed to be overwhelmed by his occasional large losses. The professional operates on the exact opposite principle. He cuts his losses short and lets his profits run as long as the underlying trend remains intact. He understands that the big money isn't made in the initial breakout or the first few points of a move. The real money is made in the middle of the great swings, in having the patience and courage to sit tight while a winning position develops its full potential. This requires a fundamental shift in mindset. Instead of fearing the loss of paper profits, you must fear the loss of the trend itself. Instead of being satisfied with small, quick gains, you must develop the discipline to hold for the big gains that can transform your financial situation. The stock market offers a few truly great opportunities each year. Your job is to recognize them when they appear and ride them for all they're worth. This philosophy of letting profits run isn't about greed or wishful thinking. It's about understanding the mathematical reality of successful speculation. If you're right only 40% of the time, which is actually quite good in this business, then your winners must be significantly larger than your losers for you to come out ahead. A trader who makes $10 on his winning trades and loses $10 on his losing trades will eventually go broke even if he's right half the time, simply due to the corrosive effect of commissions and the inevitable string of losses that will occur. But a trader who makes $50 on his winners while losing only $10 on his losers can be wrong 70% of the time and still generate substantial profits. This is the magic of asymmetric risk-reward ratios, and it's only possible when you have the discipline to let your winners develop their full potential while cutting your losers before they can inflict serious damage. Rule number 5 addresses one of the most common and destructive habits that plague amateur speculators: the compulsive need to always be in the market. Never overtrade. This simple statement contains a universe of wisdom that most traders learn only after paying a heavy tuition to the market's harsh schoolmasters. The amateur feels naked when he's not holding a position. He experiences what can only be described as market withdrawal, a nervous energy that demands constant action. He sees every minor fluctuation as an opportunity, every small movement as a potential profit source. This compulsive trading turns what should be a strategic business into a frantic gambling operation. The costs of overtrading are both immediate and cumulative. Each unnecessary trade carries with it the burden of commissions, the risk of being on the wrong side of a random movement, and the mental exhaustion that comes from constantly monitoring positions that were entered for no better reason than the inability to sit still. More insidiously, the overtrader loses his ability to distinguish between high-probability setups and market noise. His judgment becomes clouded by the emotional residue of his last trade, whether it was a winner or a loser. He develops what might be called market fatigue, a condition where his analytical abilities become compromised by the constant stress of being in action. Livermore understood that the most profitable position in the market is often no position at all. There are extended periods when the market lacks clear direction, when the various forces of supply and demand are in rough equilibrium, when the tape tells a story of confusion rather than conviction. To trade during these periods is to engage in low-probability gambling rather than high-probability speculation. The professional conserves both his financial capital and his mental capital during these barren periods. He studies the market without participating in it, sharpening his analytical skills while preserving his resources for the moment when clarity returns and genuine opportunities present themselves. Rule number 6 brings us to the mathematical foundation that makes all the other rules possible. Risk only a small fraction of your total capital on any single trade. This is where speculation transforms from gambling into a scientific enterprise governed by probability and mathematical expectation. The amateur, when seized by conviction about a particular trade, often commits a dangerously large portion of his capital to that single idea. He might risk 20, 30, or even 50% of his total funds on what he believes to be a sure thing. This approach virtually guarantees eventual ruin because even the best speculators are wrong a significant percentage of the time. The professional never risks more than 1 or 2% of his total capital on any single trade, regardless of how confident he feels about the outcome. This conservative position sizing serves as a mathematical insurance policy against the inevitable series of losses that every speculator must endure. Consider the arithmetic. A speculator who risks 10% of his capital per trade can be wrong only 10 times in a row before he's completely wiped out. But a speculator who risks only 1% per trade can be wrong 50 times consecutively and still retain half of his original capital. The first trader is playing a game he cannot possibly win over the long term. The second trader has made it mathematically impossible for the market to deliver a fatal blow. This conservative approach to position sizing actually enables more aggressive trading in terms of strategy and timing. When you know that the maximum possible loss from any single trade represents only a tiny fraction of your total resources, you can make clear, objective decisions based purely on the evidence presented by the market rather than being paralyzed by the fear of a devastating loss. Rule number 7 demands patience of a quality that few amateur speculators possess. Wait for clear market signals before committing capital. The urge to anticipate, to get in early, to catch the very beginning of a move is one of the most seductive and destructive impulses in all of speculation. The amateur is constantly trying to outsmart the market, to buy at the exact bottom and sell at the precise top. He studies charts looking for subtle patterns that might give him an edge, analyzes economic indicators that might provide a clue about future direction, and listens to the opinions of experts who claim to know what's coming next. The professional takes an entirely different approach. He doesn't try to predict what the market will do. Instead, he waits for the market to tell him what it is doing right now, in this moment, with absolute clarity and unmistakable force. He looks for what Livermore called pivotal points, moments when a stock breaks out of a period of consolidation with authority and conviction. These breakouts must meet specific criteria to qualify as genuine signals rather than false moves designed to trap the unwary. The breakout must occur at a significant technical level after a period of accumulation or distribution. It must be accompanied by a substantial increase in trading volume, indicating that smart money is behind the move. And it must demonstrate follow-through in the days immediately after the initial breakout, proving that the move has genuine staying power. To buy before these conditions are met is to act on hope rather than evidence. To buy after they've been confirmed is to act on the market's own testimony about its intentions. The difference between these two approaches is the difference between gambling and speculating, between hoping and knowing, between amateur and professional. This patience often means waiting for days, weeks, or even months for the right setup to appear. During these waiting periods, the amateur grows restless and eventually makes trades based on inferior setups, simply to satisfy his need for action. The professional understands that his capital is earning a return even while sitting in cash, because it's being preserved for the moment when a truly exceptional opportunity presents itself. Rule number 8 completes the philosophical foundation of Livermore's approach. Recognize that cash is a position, and often the strongest position of all. The amateur views being out of the market as being out of the game, missing opportunities, failing as a trader. This psychological error costs more speculators more money than perhaps any other single mistake. Cash provides something that no stock position can offer: complete flexibility and absolute clarity of thought. The speculator who holds cash is not emotionally tied to any particular outcome. He can observe market action with the detachment of a scientist rather than the anxiety of someone whose financial well-being depends on which way prices move in the next few hours. The man holding cash possesses what might be the most undervalued asset in all of Wall Street: a completely unbiased perspective. When you're not worried about protecting a position, when you're not hoping for a particular outcome, when you're not fighting the tape because your money is already committed to the wrong side of the market, your mind becomes a precision instrument capable of reading market signals with crystalline clarity. During the treacherous sideways markets that chop most traders to pieces, cash becomes your fortress. While others are being whipsawed by meaningless fluctuations, buying at small tops and selling at small bottoms, bleeding their accounts dry through 1,000 tiny cuts, you sit comfortably on the sidelines. Your capital remains intact, your emotions remain stable, and your judgment remains sharp. But perhaps most importantly, cash gives you something that no amount of market analysis or technical expertise can provide: the power to act decisively when the perfect opportunity finally reveals itself. The speculator who is fully invested, who has his capital tied up in mediocre positions, becomes a prisoner of his own past decisions. When that once-in-a-year setup appears, when the market offers one of those rare gifts that can transform a modest account into a fortune, he can only watch from the sidelines because his ammunition has already been spent on inferior targets. Now, understanding these 8 rules intellectually is one thing. Living by them when your emotions are running hot, when the market is moving against you, when everyone around you seems to be making easy money while you sit in cash waiting for the perfect setup, that's an entirely different challenge. This is where most speculators fail, not because they don't understand the principles, but because they lack the psychological fortitude to implement them consistently. Livermore learned this lesson through a series of spectacular failures that would have broken lesser men. In his early years, he possessed all the analytical skills necessary for success, but he repeatedly destroyed himself by abandoning his own rules at critical moments. The cotton debacle of 1908 serves as perhaps the most instructive example of how even a master speculator can be undone by a momentary lapse in discipline. Livermore had developed an almost supernatural ability to read the tape, to sense when a market was about to turn, to identify the pivotal points that signaled major moves. His system was telling him clearly that cotton prices were ready to collapse, that the smart money was quietly distributing their holdings to the unsuspecting public. Every instinct he had developed through years of painful experience was screaming at him to get short, to position himself for what promised to be a devastating decline. But instead of trusting his own proven methods, he allowed himself to be swayed by the persuasive arguments of Percy Thomas, the so-called Cotton King. Thomas painted a picture of inside information, of crop reports that weren't yet public, of a conspiracy among the big planters to drive prices higher. The story was compelling, the potential profits enormous, and Livermore's discipline cracked under the pressure of greed and the fear of missing out on what seemed like a sure thing. He not only ignored his sell signals, but actually began buying cotton, adding to his position as prices moved against him, convinced that his superior information would soon be vindicated by the market. The result was catastrophic. He lost not just the profits from his recent successes, but nearly his entire fortune, wiping out years of careful accumulation in a matter of weeks. This disaster taught him something more valuable than any profit could have provided: the absolute necessity of trusting his own analysis over the opinions of others, no matter how convincing they might sound. It reinforced the critical importance of cutting losses immediately rather than hoping for a reversal. Most importantly, it demonstrated that no rule, no matter how fundamental, is worth anything if you don't have the psychological strength to follow it when doing so feels impossible. The psychology of risk management extends far beyond the mechanical application of stop losses and position sizing. It requires a fundamental rewiring of the human brain's natural responses to uncertainty, loss, and opportunity. We are evolutionarily programmed to avoid losses more than we seek gains, to hold on to failing investments longer than winning ones, to seek the comfort of the herd rather than the isolation of independent thinking. Every one of Livermore's 8 rules runs counter to these natural impulses. Cutting losses quickly feels like admitting failure. Letting profits run feels like tempting fate. Waiting for clear signals feels like missing opportunities. Holding cash feels like being lazy or fearful. The amateur speculator is constantly at war with his own psychology, and more often than not, psychology wins. The professional learns to view these psychological impulses not as personal failings, but as predictable obstacles to be systematically overcome. He develops what might be called emotional muscle memory, practicing his responses to common market scenarios until following his rules becomes as automatic as breathing. He knows that in moments of high stress, when large sums are at stake and time pressure is intense, he will not have the luxury of careful deliberation. His responses must be immediate, instinctive, and correct. This is why successful speculators often seem almost robotic in their approach to trading. They're not lacking in passion or conviction. Rather, they've learned to channel those powerful emotions into the disciplined execution of their proven methods. They understand that the market is designed to exploit emotional decision-making, and they refuse to give it that opportunity. The development of this psychological discipline requires what Livermore called paying tuition to the market. Every speculator must go through a period of painful losses, of watching his theories crumble under the weight of reality, of learning that the market cares nothing for his hopes, fears, or financial needs. Those who survive this educational process emerge stronger, wiser, and infinitely more dangerous as competitors. But here's the crucial point that separates the eventual winners from the permanent losers. You must learn the right lessons from your failures. Many speculators interpret their losses as evidence that the game is rigged, that success is impossible for anyone who doesn't have inside information or unlimited capital. They become bitter, cynical, and ultimately abandon the field entirely. The future masters interpret their losses differently. They see each mistake as valuable data, each failure as a tuition payment toward their eventual education. They study their errors with the same intensity that they study their successes, looking for the specific psychological or technical factors that led to the poor decision. They adjust their methods, strengthen their discipline, and return to the market better prepared for the next challenge. This process of continuous improvement never really ends. Even Livermore, after decades of experience and multiple fortunes made and lost, continued to refine his approach right up until the end of his career. The market is constantly evolving, presenting new challenges and new opportunities for those prepared to meet them. The regulatory environment changes, introducing new rules and restrictions that can render old strategies obsolete. Technology advances, speeding up the pace of trading and creating new sources of information and analysis. Economic conditions shift, altering the fundamental drivers of market behavior. The successful speculator must adapt to these changes while maintaining his commitment to the timeless principles of risk management. This is perhaps why rules remain as Livermore's 8 relevant today as they were nearly a century ago. They address the unchanging realities of human psychology and market behavior rather than the temporary tactical considerations that dominate most trading advice. Greed, fear, hope, and ego affected speculators in 1929, exactly as they affect traders today. The tendency to hold losers and sell winners was as destructive then as it is now. The tools available to modern speculators are infinitely more sophisticated than anything Livermore could have imagined. We have real-time data streams, complex analytical software, instantaneous order execution, and access to markets around the globe. But none of these technological marvels address the fundamental challenge that destroyed speculators in Livermore's day and continues to destroy them today: the management of risk, and the control of emotion. Consider how many of today's most prominent financial failures can be traced directly to violations of Livermore's basic principles. Hedge funds that blow up spectacular because they concentrated too much capital in a single trade. Day traders who turn small losses into account-killing disasters because they refused to cut their positions when the market moved against them. Investment managers who chase performance by abandoning their proven methods in favor of whatever strategy is currently popular. The technology has changed, but the underlying human dynamics remain constant. The amateur still comes to the market asking how much money he can make. The professional still begins with the question of how much he can afford to lose. The difference in outcomes flows inevitably from this difference in approach. Understanding this continuity helps explain why studying the masters of the past remains so valuable for today's speculators. The specific techniques they used may be obsolete, but the principles that guided their success are eternal. They struggled with the same psychological demons, faced the same emotional challenges, and overcame the same natural human tendencies that continue to defeat the majority of market participants. Livermore's greatest contribution wasn't his ability to predict market movements or his skill at timing entries and exits. It was his systematic approach to managing the inevitable uncertainties of speculation. His recognition that success comes not from being right all the time, but from controlling what happens when you're wrong. This insight transforms speculation from a game of prediction into a game of preparation. Instead of trying to forecast the future, which is impossible, you focus on positioning yourself to profit regardless of what the future brings. Instead of seeking the perfect trade, which doesn't exist, you develop a system that can generate profits even when most of your individual trades are unprofitable. The mathematics of this approach are compelling. A speculator who wins on only 30% of his trades can still generate substantial profits if his winners are large enough and his losers are kept small. But a speculator who wins on 70% of his trades will still go broke if he allows his occasional losses to grow large enough to overwhelm his many small gains. This is why position sizing becomes so critical to long-term success. It's not enough to have good market judgment if you're risking so much on each trade that a normal string of losses can wipe you out. It's not enough to cut your losses quickly if you're taking positions so large that even a quick cut represents a devastating blow to your capital base. The interconnected nature of these rules means that weakness in any one area can undermine your entire operation. You might be excellent at identifying high probability setups, but terrible at letting your profits run. You might be disciplined about cutting losses, but unable to resist trade during the overslow periods. You might have perfect position sizing, but lack the patience to wait for clear market signals. Mastery requires attention to all 8 principles simultaneously, treating them not as separate rules, but as components of an integrated system. Each rule supports and reinforces the others, creating a framework that becomes stronger than the sum of its individual parts. This is why piecemeal implementation rarely works. You can't choose to follow only the rules that feel comfortable while ignoring the ones that challenge your natural inclinations. The commitment required to implement this system consistently separates the serious students of speculation from the casual participants who treat the market as an expensive form of entertainment. It demands a level of self-discipline that most people simply aren't willing to develop, a willingness to do what's right rather than what feels good, and the patience to build wealth slowly rather than seeking the instant gratification of quick profits. But for those who make this commitment, who pay the price in study and discipline that mastery requires, the rewards extend far beyond mere financial gain. They develop a deep understanding of market behavior, an ability to remain calm under pressure, and a systematic approach to decision-making that serves them well in all areas of life. The path forward from here requires honest self-assessment and systematic implementation. Which of these 8 rules do you currently follow consistently? Which ones do you understand intellectually but struggle to implement emotionally? Where are the gaps in your current approach that leave you vulnerable to the market's inevitable tests of your discipline and resolve? The journey from understanding these principles to living them begins with a brutal confrontation with your own trading history. Pull up your records from the last year. Look at every trade, every decision, every moment where emotion overrode logic. What you'll likely discover is a pattern of self-sabotage that follows the same destructive script played out by countless speculators before you. You'll see the trades where you held losing positions far too long, watching small setbacks transform into account-crippling disasters. You'll find the winners you sold too early, afraid that paper profits would evaporate if you didn't lock them in immediately. You'll identify the periods where you traded frantically, churning your account in search of action rather than waiting patiently for genuine opportunities. Most painfully, you'll recognize the moments where you abandoned your own rules because this time felt different, because the opportunity seemed too good to pass up, because everyone else was making money and you feared being left behind. These violations of discipline, these moments of weakness, these surrenders to emotion are where fortunes are lost and dreams are shattered. But here's what separates the future masters from the permanent casualties: the willingness to confront these failures honestly and learn from them systematically. Each mistake contains within it the seeds of future success, provided you're willing to dig deep enough to extract the lessons and humble enough to change your behavior accordingly. Start with the most fundamental question of all. Do you currently have a systematic approach to position sizing, or do you simply buy as many shares as feels right in the moment? If you're like most amateur speculators, your position sizes vary wildly based on your confidence level, your recent performance, or your current emotional state. This randomness virtually guarantees eventual ruin because it means your largest positions will inevitably coincide with your worst judgment. Implementing proper position sizing requires cold mathematical discipline that feels almost mechanical in its precision. Before you ever place a trade, you must determine exactly how much of your total capital you're willing to risk if the trade goes completely wrong. This amount should never exceed 1 to 2% of your total account value, regardless of how certain you feel about the outcome. Let's make this concrete with real numbers. If you have a $50,000 account, your maximum risk per trade should be between $500 and $1,000. If you want to buy a stock at $50 per share with a stop loss at $45, you're risking $5 per share. This means you can buy a maximum of 100 to 200 shares, depending on your risk tolerance. Notice what this calculation doesn't include: your opinion about the stock's prospects, your confidence in the trade, your recent performance, or your current financial needs. The position size is determined purely by the mathematical relationship between your total capital, your acceptable risk per trade, and the specific risk parameters of the individual trade. This mechanical approach to position sizing eliminates one of the most dangerous variables in speculation: the emotional sizing of positions based on conviction rather than capital preservation. It forces you to think in terms of risk first and reward second, which is the hallmark of professional money management. But position sizing alone isn't enough if you don't have the discipline to honor your predetermined stop losses. The stop loss isn't a suggestion or a guideline. It's a sacred commitment you make to yourself before emotion and hope cloud your judgment. When that level is hit, you sell immediately and without question, regardless of what your heart is telling you about the stock's potential for recovery. The psychological difficulty of honoring stops cannot be overstated. Every fiber of your being will rebel against taking that loss. Your mind will generate a dozen reasons why this time is different, why the stop loss was set incorrectly, why just a little more time will prove your original judgment correct. These thoughts aren't signs of intelligence or insight. They're the death songs of amateur speculators throughout history. Professional money managers often automate this process specifically to remove the emotional component from stop-loss execution. They place their sell orders immediately after entering a position, creating a mechanical system that executes regardless of their feelings in the moment. This isn't cowardice or lack of conviction. It's the recognition that human psychology is predictably unreliable under pressure. The flip side of cutting losses quickly is the equally challenging discipline of letting profits run. While amateurs hold their losers hoping for recovery, they simultaneously sell their winners fearing the loss of paper profits. This backwards approach to position management guarantees mathematical failure over time because it means your losses will be large and your gains will be small. Learning to hold winning positions requires a fundamental shift in how you think about unrealized profits. That paper gain isn't money you've made that might be taken away. It's evidence that you've correctly identified a trend that may have much further to run. Your job isn't to protect those paper profits by selling prematurely. Your job is to ride the trend as long as it remains healthy and intact. This doesn't mean holding blindly or ignoring signs that the trend is weakening. It means using trailing stops or other mechanical methods to protect your gains while giving the position room to breathe and develop. It means accepting that you'll give back some profits at the end of every major move in exchange for capturing the bulk of the trend. These 8 principles transformed Jesse Livermore from a penniless farm boy into one of the wealthiest men of his era. But more importantly, they represent timeless truths about human nature and market behavior that remain as relevant today as they were a century ago. The technology has evolved, the speed of execution has accelerated, and the complexity of financial instruments has multiplied, but the fundamental challenge remains unchanged. The battle between emotion and discipline, between hope and reality, between amateur impulses and professional execution. Master these rules, implement them with unwavering consistency, and you'll possess the same armor that protected Livermore through decades of market warfare. The question isn't whether these principles work, but whether you have the courage to live by them when everything inside you screams to do otherwise.